Ever feel like you're trying to solve a puzzle, but everyone else has the instruction manual? Today, we're going deep on this idea of having an informational edge, that advantage you get when you know something others don't, or at least when you're using information in a way that they're not.
Right.
And it reminded me of something Peter Norvig said. He's a huge name in AI, the former director of research at Google Search.
Oh, yeah. I know Peter Norvig.
He said, "We don't have better algorithms, we just have more data."
Hmm.
And I think that quote really gets at the heart of what we're talking about today. If you can find unique data and you're smart about how you analyze it, that can be the key to unlocking so much potential, not just in the market, but in any field, really.
Absolutely. And that's exactly what we're digging into today. We're going to look at how you might build a market-neutral trading strategy, and the key is using new sentiment data. It'll be our informational edge. We'll be pulling from quant trading rules for this deep dive, and they present a really fascinating approach.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so before we go any further, let's define some terms here. What exactly do we mean when we talk about an edge in trading? Because it does sound a bit like one of those buzzwords that gets thrown around a lot.
Yeah, it's definitely become a bit of a buzzword. But the core idea is simple. It's any advantage, any sort of consistent advantage you can get that improves your odds of making profitable trades. And the key here is consistent. We're not talking about a lucky win here and there,
Right.
A real edge, a genuine edge. You have to be something that's repeatable, testable, actionable, and most importantly, durable. It has to provide value over time, not just for a little while.
So it's got to be something you can rely on, something you can measure, and something that actually helps you make decisions, not just some random hunch or feeling.
Exactly. And there are actually several different types of edges you can have in trading.
Oh, interesting. The article touched on a few, right?
Yeah, it did. And today, we're going to laser focus on informational edge, which is, as we said, about knowing something that others don't. But just to give you the full picture, you could also have an analytical edge. This is where you're just better at interpreting the same information everyone else has. Like you see connections, you see patterns that others miss.
I see.
Then there's behavioral edge. It's all about keeping your cool, staying rational when others are making emotional decisions,
Yeah.
letting fear and greed drive their actions while you stay disciplined.
It's tough. It's tough.
It is. It is. You could also have structural edges. These come from things like lower training costs. Maybe you have better access to certain markets or information.
Okay.
And finally, there's technical edge. This might involve having faster trading technology or algorithms, giving you a speed advantage.
Got it. So we've got a whole buffet of edges to choose from. But for today's deep dive, we're firmly in the informational edge camp. We're all about finding hidden insights in those less conventional data sets.
Absolutely. And this is where alternative data comes into play, which the article talks about a lot. As traditional financial data becomes more and more readily available, everyone has access to it. And so the edge starts to erode. That's why people are turning to these alternative data sets, things like satellite imagery, credit card transactions, consumer reviews, social media trends.
Wow, so much data.
And of course, as we're exploring today, news sentiment.
Right.
The goal is to find those unique and actionable signals before everyone else jumps on board, before they become common knowledge and lose their predictive power.
Okay, so that brings us to our main course for today, the news sentiment data set. What exactly is this stuff and where does it come from?
So news sentiment data, it's essentially the result of using artificial intelligence, specifically natural language processing, to analyze vast amounts of news text.
Okay.
Imagine computers reading and understanding news articles, headlines, press releases, and then assigning scores based on whether the overall tone is positive, negative, or neutral.
So instead of me having to go through every single financial publication out there, a computer does it for me, and it gives me like the Cliff's Notes version with an emotional rating attached.
Yeah, it's like that, but much more sophisticated and automated.
Right.
There are firms out there that do this. They collect raw news feeds from premium providers like Dow Jones. Then their NLP systems, their algorithms, they get to work analyzing all this text, breaking it down and generating a detailed set of data points. This includes things like the stock ticker, the exact timestamp when the news hit, probabilities for positive, negative, neutral sentiment, a relevance score that tells you how closely the news is actually related to the company, and even categorized topics. And all of this information, it's often delivered in real time, almost instantaneously, within seconds or minutes of the news being published.
Wow, that's fast.
Yeah, it's incredible how quickly these systems can process information nowadays.
But I'm guessing there must be some challenges in actually using all this data. It just seems like so much information to handle.
You're absolutely right. Dealing with the sheer volume of data, I mean, we could be talking about millions and millions of data points. That's a huge hurdle in itself.
Yeah.
And like any raw data, it needs to be carefully cleaned, pre-processed, before you can start building any models or making any decisions based on it. You have to make sure it's accurate, that it's consistent, that it's in a usable format.
Garbage in, garbage out, as they say.
Exactly. So we have this massive data set of news with all these sentiment scores.
Right.
Now, how do we actually transform that into a trading strategy that might give us an edge? That's where this simple model comes in.
All right, let's talk about the model.
So the goal of this model was to see if we could predict how a stock would perform the next day, and specifically the change in its closing price from one day to the next. And we're only using new sentiment data from the previous 24 hours.
So past news sentiment predicting future price changes. That's the basic idea, right?
Exactly. But right away we run into a challenge. How do you combine sentiment scores when a company has multiple news articles about it?
Yeah, that makes sense. Some companies are going to have tons of coverage, others might have very little.
Right. Or what if there's no news at all? You can't just average those sentiment scores directly.
I see the problem. You'd need some way to standardize or normalize that sentiment across all those different stocks.
You got it. So the approach they took in this research was really interesting. It's inspired by something called log odds ratio. They're often used in statistical modeling in different fields. And the formula they used to convert all those sentiment probabilities into a single score that you could actually work with.
That's pretty clever. So you calculate this final score for each stock, and you do it every day based on all the news from the previous day. And I noticed in the article that they did some pre-processing steps before actually feeding those scores into their model.
Oh, absolutely. Data preparation is crucial, and they did a few important things here. First, they standardized the returns within each GICS sector. GICS is a system for classifying companies into different industries.
Yeah.
So instead of trying to predict the absolute return of a stock, they're looking at how a stock will perform relative to its peers in the same industry.
So how it does compared to other companies in the same sector.
Right. Then they filtered out any news articles that fell below a certain relevance threshold. They want to make sure the model is only considering the most pertinent information, not just any random news that mentions a company in passing.
Okay, so focus on the really relevant stuff.
Exactly. And finally, they used a technique called one-hot encoding,
That sounds familiar.
a common technique in machine learning for handling categorical data. In this case, you have those topic tags associated with each news article, right?
Right.
One-hot encoding is a way for the computer to understand those different topics as distinct categories that it can actually analyze. Imagine sorting the news into different buckets based on topic. One-hot encoding just transforms those buckets into a format the model can work with. And the model they chose was linear regression, which seems surprisingly simple given all the complexity we just talked about with the data.
It might seem simple, but there are good reasons for starting with linear regression. For one, it's relatively easy to interpret, especially compared to some of those more complex black box algorithms. You can actually see how those sentiment scores relate to the predicted returns. It helps with understanding what's driving the results.
Plus, linear regression tends to work reasonably well when you have a moderate number of features and a fair amount of noise in the data. And that's often the case when we're dealing with financial markets. The signal is not always crystal clear.
Right, lots of randomness and volatility.
Exactly. And another big advantage is that it's fast to train and test. You can get results quickly, which is always a plus. It gives you a good baseline to see if there's any real predictive power in the news sentiment data itself.
So a good starting point, a solid foundation.
Exactly. And if it works well, then great. If not, you can always explore more complex models later. And it gives you something to compare against.
A benchmark.
Right. And for this research, they used a rolling training approach.
Rolling training, what's that?
So they used the past 10 years of data to train the model at the beginning of each subsequent year.
Oh, I see. So the model is constantly learning and adapting based on the most recent data.
Exactly. It's like it's always catching up, staying up to date with the latest trends. All right, so we've got our data pre-processed, we've built our model. Yeah, how do we actually use all this to create a trading strategy? What's the core idea here?
Yeah, how do we turn all this data and analysis into actual trades?
Well, the first strategy they tested was actually pretty straightforward. At the end of each trading day, they use the sentiment signal from the previous 24 hours of news, and they rank all the stocks in their investment universe based on that signal. Then they take long positions. They buy the top 20% of stocks with the highest positive sentiment signal.
So buy the ones that are getting the most positive buzz.
Yep, that's the top quintile.
Right.
And on the flip side, they take short positions. They bet against the bottom 20% of stocks, the ones with the most negative sentiment, the bottom quintile. They hold these positions for 24 hours, just one day, and then repeat the process the next day.
So buy on good news, sell on bad news, and hold for a day. Pretty intuitive. What's the theory behind why this should work?
The underlying idea is that positive news sentiment, on average, it should lead to positive price movements in the short term. And negative sentiment should lead to negative price movements.
Makes sense.
So by going long on the most positively mentioned stocks and shorting the most negatively mentioned ones, you're essentially trying to profit from these short-term reactions to news.
Riding the waves of sentiment.
You could say that. So how did this simple strategy actually perform?
Yeah, let's get to the results.
The initial backtesting results, they were pretty impressive, actually. The strategy achieved a Sharpe ratio of 1.88 compared to just 0.73 for their benchmark.
Remind me what Sharpe ratio measures again.
It's a measure of risk-adjusted return. The higher the Sharpe ratio, the better the return you're getting for the level of risk you're taking on. So 1.88 is pretty good.
Okay, yeah, that sounds pretty good.
The annualized return was 18.7%. That's significantly higher than what the market delivered over the same period. And perhaps even more interesting, the maximum drawdown, that's the largest peak to trough decline, it was only 11% for the strategy.
Much lower than the benchmark's 34%.
Exactly. And the correlation with the benchmark, very low, 0.01. This suggests that the strategy was indeed market neutral, meaning its performance wasn't strongly tied to the overall direction of the market. It's doing its own thing.
So you could potentially add this to a portfolio, and it wouldn't just be replicating what the market is already doing.
Exactly. It adds diversification. It's a different source of return. So yeah, overall, those numbers are really compelling, especially that Sharpe ratio and the low drawdown, a market neutral strategy.
It almost sounds too good to be true.
It does raise an eyebrow. And even the researchers, they noted one unexpected finding. The second highest sentiment quintile, so not the most positive one, but the second most positive, actually showed a slightly higher average return than the top quintile.
Oh, that's interesting. So more positive sentiment didn't necessarily mean higher returns.
Yeah, that's right.
So it's not a perfect one-to-one relationship.
It's not that perfectly smooth relationship you might expect, where more positive sentiment consistently equals higher returns. It suggests that there's more complexity at play here. There might be some other factors influencing those returns, or maybe the relationship between sentiment and price movements is not purely linear.
Okay, so something to investigate further. They also highlighted a practical challenge with this initial strategy.
Yeah, and it's a big one. In real-world trading, it's not always easy or cheap to short every single stock your model tells you to.
Yeah, I was wondering about that.
There can be limits on how many shares you can borrow, and those borrowing costs can really add up, especially for smaller, less liquid stocks.
So it's not as simple as just clicking a button and saying, short this.
Not always. So to make the backtest more realistic, more grounded in the real world, they added a constraint. They limited their short positions to only the stocks that were part of the S&P 1500 index.
Okay, so focusing on the bigger, more well-known companies.
Exactly. They figured those would generally be easier and cheaper to short.
And how did that affect the strategy's performance?
Well, it's interesting. It actually improved the results even further. The Sharpe ratio went up to 2.14, and the annualized return increased to 21.4%. The maximum drawdown did tick up a little bit to 13%.
Still significantly lower than the benchmark.
Still way lower. And that correlation with the market, still tiny, negative 0.01. Plus the overall stats of the trades, things like win rate and average profit per trade, they all look better with this constraint in place.
Wow, so making the strategy more practical, more realistic, actually made it perform even better?
It seems counterintuitive, but that's often the case in quantitative trading. You got to find that balance between theoretical optimality and real-world constraints.
And I remember they also experimented with adding a little bit of net long exposure to the strategy,
Yeah,
right?
they did. They figured since the stock market tends to go up over the long term, why not try to capture a bit of that natural upward drift?
Right. So instead of being perfectly market neutral, tilt it slightly towards being long.
Exactly. They tested a positive net exposure of 10%. And, as expected, it did boost the overall returns even further. But of course, there's no free lunch. This also increased the maximum drawdown. There's always a trade-off.
So higher potential returns, but also higher potential for losses.
Right. Risk and reward, they go hand in hand. And they did some further analysis looking at the monthly and annual performance of this slightly net long version going all the way back to 2010. Only one negative year in that whole period. Pretty impressive. Most of the months were positive too, but they did point out the best and worst monthly returns to give a sense of the range. The best month was up over 14%, while the worst was down about 9%.
Okay, so some volatility there.
Yeah, some swings, but overall, a very strong track record.
So the back tests look great on paper, but are we sure these returns are really coming from the new sentiment signal? Couldn't they be explained by some other factors?
That's the million-dollar question, right? Are we really capturing something unique here, or are we just fooling ourselves? So to really dig into that, they used the Fama-French three-factor model. This model is super popular in finance for analyzing investment returns.
Remind me what those three factors are again.
Okay, so you've got market risk. This is just the overall performance of the market. Then you've got size. This captures the tendency for smaller companies to outperform larger ones, at least historically.
Okay, small versus big.
Right. And finally, you have value, which captures the tendency for undervalued stocks to outperform growth stocks. Classic value versus growth debate.
Yeah.
So by including these three factors in their analysis, they can see how much of the strategy's performance is actually due to these common risk factors and how much is truly coming from the news sentiment signal itself.
And what did the analysis reveal?
It showed a statistically significant annualized alpha of 24.4%. Alpha, in this context, it represents the return that's not explained by those three common factors. It's the excess return.
Okay.
And an alpha of 24.4%. That's substantial. It suggests that the news sentiment signal is indeed providing a unique source of returns. It's not just that the strategy happened to be invested in, say, small-cap stocks during a period when small caps were doing well. There's something more going on here.
So the new sentiment signal, it's actually adding value above and beyond what you'd expect from those standard market factors.
That's the key takeaway here. And the analysis also revealed a negative exposure to market risk, which reinforces that market-neutral aspect. The strategy tends to hold up well even when the overall market is taking a hit. It's like a cushion. And there was a positive exposure to the size factor. This means that the strategy might have a slight tilt towards smaller companies. But there was no significant exposure to the value factor.
Interesting. So it leans towards small, but doesn't really care about value versus growth.
Right. So the news sentiment signal, it seems to be driving a good chunk of those returns, independent of those well-known factors, with a bit of a preference for smaller companies.
Very cool. So overall, this research paints a pretty positive picture of using news sentiment data, but I'm sure there are some potential downsides or limitations that we should be aware of.
Absolutely. No strategy is perfect, and it's important to acknowledge the potential pitfalls. For starters, it's important to remember that this is just a starting point, a baseline model. It's relatively simple. And that quirk we talked about earlier, where the second highest sentiment group outperformed the top group, that suggests that the relationship between sentiment and returns might be more complex than this model captures.
Right. There might be more to the story.
Maybe. And it's possible that more sophisticated modeling techniques could potentially unlock even more insights, could potentially improve the results even further.
So room for improvement.
Always. And another crucial point is that the entire strategy hinges on the availability and cost of high-quality news sentiment data. This stuff, it's not free. It's a premium product.
Yeah, you got to pay for that good data.
You do. And not everyone has access to it. So that's a real barrier to entry for some people.
Right. If you can't get the data, you can't implement the strategy.
Exactly. And remember that constraint they added to the backtest, limiting the short positions to the S&P 1500. That was a practical simplification. But in the real world, shorting can still be tricky and expensive, even for those large cap stocks. There are always hidden costs, unexpected challenges that can pop up.
So the backtest might not perfectly reflect real-world performance.
Right. And while linear regression was a good starting point, the researchers acknowledged that nonlinear models could potentially do a better job.
Okay, so potentially better ways to model this relationship.
Yeah. Maybe some of those more complex machine learning algorithms can really capture the nuances of how sentiment affects prices. And finally, even with a strong informational edge, you can't just set it and forget it.
Right.
Successful implementation in the real world, it requires constant monitoring, careful model construction, thorough data pre-processing, robust risk management, and disciplined execution. And transaction costs and market impact, these things can really eat into your profits, and they weren't explicitly modeled in this research.
So the actual returns could be lower than what the backtests show?
Potentially, yeah. It's always good to be conservative when estimating real-world performance.
Okay, so a lot to consider, a lot of nuances.
Definitely. This is not a get-rich-quick scheme.
But it is a very fascinating approach. I mean, the idea that you can use new sentiment data to potentially generate these attractive market-neutral returns, that's pretty compelling.
It is. It really highlights the power of alternative data and how thinking outside the box can potentially lead to real rewards.
Exactly. And if a relatively basic model can achieve these kinds of results, imagine what's possible with more advanced techniques and even richer data sets.
Exciting to think about.
It really is. It just underscores the importance of looking beyond the obvious, of seeking out those unique insights that others might be missing. And that's true not just in finance, but in any field where information is key.
I completely agree. In a world where data is becoming increasingly abundant, the ability to find and analyze that unique piece of information, that hidden gem, that's what can really set you apart. That's what can give you a true edge.
That's a great note to end on. Thanks for joining me on this deep dive.
Always happy to explore these fascinating topics.
And to our listeners, keep exploring, keep questioning, keep seeking out those informational edges. You never know what you might discover.
Absolutely. Happy trading, everyone.
And until next time.